It's another edition of the Trading Tips video newsletter, teaching you how to become a successful trader today. This video newsletter is brought to you by firsthourtrading.com.
Welcome to this edition of the TradingTips.com video newsletter. In this episode, we'll be looking at money management techniques for traders. Having a trading plan is essential, and the most essential element of any trading plan is money management. So without further ado, let's begin. Now, it's a bit cliche to say that you can't succeed without a trading plan. You can. It's just not very likely. There are always geniuses and idiot savants that are just so good at a particular thing they can break all the rules and still have success. But unless you're a Michael Jordan or Ernest Hemingway, Andy Warhol, or Dustin Hoffman's character Rain Man, chances are you do need a plan, and the most critical part of any trading plan is money management. A trading plan involves a set of rules governing the conditions under which you buy and sell. This is important, but having a trading plan that doesn't take money management into consideration is like trying to do a triathlon when you don't know how to swim. Money management rules need to be part of your plan. It's at least 1/3 of the game, and if you don't know what you're doing, you could end up underwater and find yourself drowning, to continue that triathlon metaphor. And if you want to get to the finish line, you need to first learn how to swim, and that means establishing money management rules. The first principle of any money management plan is maximum risk. Here you set the maximum portion of your account you're willing to risk on any one single trade. Experts normally recommend a maximum risk of no more than 2 to 5%, and most lean more towards that 2% figure. 2% may not seem like a lot, but let me explain. If you had a starting portfolio of, say, $5,000, a small portfolio, and you set your maximum loss at 2%, this means you'd be willing to risk no more than $100 on a given trade. That does not mean you'd invest no more than $100 in any given stock. It's just that you'd set your stop loss to avoid losing more than $100. Keeping with the previous example, imagine you purchase 100 shares of XYZ at $20 a piece for a total of $2,000. If you wanted to keep your maximum risk at $100, you'd want to set a stop loss at $19. There'd be a loss of $1 per share or $100 total if the trade went bad. A more aggressive approach might risk up to 4% of the 5,000 portfolio total, or $200 in any given trade. This would result in a stop loss of $18 on a $20 stock. Even more aggressive, a 5% max loss would mean a stop loss of $17.50 in this example. Now, the difference between a $19 and a $17.50 stop loss may not seem like a lot, but let's take a look at what would happen if these three traders, if they all suffered 4 consecutive losses. Trader 1 would be down to $4,612 in his account, but Trader 3 would be down to $4,073. That's a big difference. To get back to even, Trader 1 would need to post gains of 8.4%. Trader 2, however, would need to post gains of more than 22.75%. This is why money management is the most important aspect of any trading plan. Maximum loss is only one part of money management, though. An equally important concept is that of account drawdown. Whereas maximum risk deals with the most you're willing to lose on a single trade, account drawdown sets the maximum you're willing to lose in a single day or week, month, etc. Once that threshold has been hit, you fold up your tent and call it quits for the rest of the period in question. This could happen even without triggering any of your max loss stop losses. For example, let's say you have a $30,000 account and you're willing to risk a maximum of 2% per trade. This would work out to $600 per trade, the maximum you're willing to lose. Let's say you held 5 positions, all roughly $4,000 each. That'd be about $20,000 invested of your $30,000 account total. Finally, let's say you have a maximum drawdown of 5% on a given day, which means you'd never want to be down more than $1,500 on a given day. So if one of your 5 positions was down $100, another was down $200, and 4 more were down $300 each, you'd be down $1,500 for the day without any of your positions being down to your maximum per trade loss of $600. In this case, it would be time to pull the plug on all these trades, call it quits, and live to trade another day. Now the flip side of money management is taking profits. You can apply the same concepts of maximum loss and account drawdown to taking profits too. For example, you can set the maximum profits you're looking for in an individual stock based on a percentage of your account, and you can also set a maximum profits you're looking for on a given day, which is kind of like the opposite of account drawdown. This way you can exit the market with your chips and come back another day when prices are down. That's when you can buy. This is how people really make money in the stock market. We hope you've enjoyed this TradingTips.com video newsletter. Thanks for watching and good trading.
This Trading Tips video newsletter has been brought to you by Manny Bacchus's First Hour Trading System. Every day there's money to be made in the first hour of stock trading. This is the world of day trading, not for novices, unless you have a system. The First Hour Trading System. Visit firsthourtrading.com now and sign up for a free 30-day trial. You could make enough in the first hour of your day to take the rest of the day off. View more Trading Tips videos. Visit tradingtips.com. Sign up for our free video newsletters and become a successful trader today.